Welcome to our channel, Stock Market Analyst. Today, we're diving into the basics of initial public offerings, or IPOs. By the end of this video, you'll have a clear understanding of what IPOs are, how they work, and why companies go public. Don't forget to like, subscribe, and hit the bell icon for more investing tips. What is an IPO? Let's start with the basics. An initial public offering, or IPO, is the process by which a private company offers its shares to the public for the first time. This means that the company is transitioning from being privately held to publicly traded on a stock exchange. Think of it as a company opening its doors to the public and allowing anyone to buy a piece of it. How does an IPO work? Here's how an IPO works. 1. Preparation. The company decides to go public and hires investment banks to help with the process. These banks are known as underwriters. 2. Filing. The company files a registration statement with the Securities and Exchange Commission, SEC, in the United States, or the equivalent regulatory body in other countries. This document, called the prospectus, provides detailed information about the company's business, financials, and risks. 3. Roadshow. The company's executives and underwriters go on a roadshow to promote the IPO to potential investors. They present the company's story, growth prospects, and financials to generate interest. 4. Pricing. Based on investor demand and market conditions, the underwriters set the IPO price, which is the price at which the shares will be sold to the public. 5. Launch. On the IPO day, the company's shares are listed on a stock exchange and trading begins. Investors can now buy and sell the shares in the open market. Why do companies go public? Companies go public for several reasons. 1. Raise capital. Going public allows companies to raise significant amounts of capital by selling shares to the public. This capital can be used for expansion, research and development, debt repayment, and other business needs. 2. Increase visibility. Being publicly traded can increase a company's visibility and credibility. It can attract more customers, partners, and talented employees. 3. Provide liquidity. An IPO provides liquidity to the company's existing shareholders, such as founders, employees, and early investors. They can sell their shares in the open market and realize gains. 4. Facilitate mergers and acquisitions. Publicly traded shares can be used as currency for mergers and acquisitions, making it easier for companies to grow through strategic deals. Risks and challenges of IPOs. While IPOs offer many benefits, they also come with risks and challenges. 1. Market volatility. The stock market can be volatile, and the company's share price may fluctuate significantly after the IPO. This can impact the company's valuation and investor sentiment. 2. Regulatory compliance. Public companies must comply with strict regulatory requirements, including regular financial reporting and disclosure. This can be time-consuming and costly. 3. Pressure to perform. Public companies face pressure from shareholders and analysts to deliver consistent financial performance and growth. This can lead to short-term decision-making and increased scrutiny. 4. Loss of control. Going public can dilute the ownership and control of the company's founders and early investors. They may have to answer to a larger group of shareholders and a board of directors. How to invest in IPOs. Investing in IPOs can be exciting, but it's important to do your research and understand the risks. Here's a step-by-step guide to investing in IPOs. 1. Research the company. Read the company's prospectus and understand its business model, financials, growth prospects, and risks. Look for red flags and potential challenges. 2. Check the underwriters. Look at the reputation and track record of the investment banks underwriting the IPO. Reputable underwriters can indicate a higher quality offering. 3. Evaluate the valuation. Compare the IPO price to the company's financials and industry peers. Make sure the valuation is reasonable and justified. 4. Consider your investment goals. Determine if the IPO aligns with your investment goals and risk tolerance. IPOs can be volatile, so be prepared for price fluctuations. 5. Place your order. If you're interested in investing, place an order through your brokerage account. Some brokers offer access to IPO shares, while others may require you to buy shares in the open market after the IPO. Practical example. Let's look at a practical example. Here's the IPO of Airbnb, ticker symbol ABNB. Airbnb went public in December 2020, raising billions of dollars. The company's shares were priced at $68 per share, and the stock surged on its first day of trading. By understanding the IPO process and evaluating the company's prospects, investors can make informed decisions about participating in IPOs. To sum up, an initial public offering, IPO, is the process by which a private company offers its shares to the public for the first time. Companies go public to raise capital, increase visibility, provide liquidity, and facilitate growth. While IPOs offer opportunities, they also come with risks and challenges. By doing thorough research and understanding the process, investors can make informed decisions about investing in IPOs. That's a wrap on our guide to initial public offerings, IPOs. If you found this video helpful, please give it a thumbs up, subscribe to our channel, and share it with your friends. Have any questions or topics you'd like us to cover? Drop them in the comments below. Happy investing!